Hello, everyone. Thank you so much for tuning in to the NetSuite Podcast. I'm Megan O'Brien, a co-host of the podcast. We have quite a unique episode in store for you all today. Recently, NetSuite has been hosting events in various different cities across the U.S. called Business Grows Here. This tour is geared towards helping local entrepreneurs and business leaders discover strategies and tools essential for business expansion, as well as valuable insights on effectively managing all aspects of a growing business, from cash flow to overall operations. The events are tailored to the unique challenges and opportunities of each city and feature local leaders and visionaries. In the St. Louis tour stop, one of the sessions that really stood out to me was a panel on the current venture capital landscape. It was moderated by JD Weinstein, Global Director of Oracle's Venture Capital Practice, and featured Dan Connor, General Partner at Ascend Venture Capital, and Craig Herron, Managing Principal at iSelect. There's a lot of great insight in there around the market build back, what venture capitalists are looking for right now in companies, and how founders can increase their chances of getting funding. After hearing it, I knew I wanted to share the valuable insights with all of you, our wonderful listeners. With that, let's jump in, because you're not going to want to miss out on this episode.
You're listening to the NetSuite Podcast, where we discuss what's happening within NetSuite, why we're doing it, and where we're heading in the future. We'll dive into the details about the software and the people at NetSuite who are behind all the moving parts. We'll also feature customer growth stories, discussing the ups and downs of running a company and how one integrated system can help your business continue to scale.
To kick us off, we have JD Weinstein, the Global Director of Oracle's Venture Capital Practice, who moderated the panel. He joined us for a quick interview just to give an overview of the session and some of his key takeaways. Could you begin by telling our listeners a little bit about yourself and what you do for Oracle?
Sure thing. My name is JD Weinstein. I joined Oracle just over 6 years ago and now lead our global venture practice. I've previously worked for various early stage accelerator programs and strategic or corporate venture funds to help entrepreneurs grow their businesses with special advantages. At Oracle, we work alongside VCs globally to help early stage portfolio companies scale with our cloud technology solutions, global customer network, and rich enterprise ecosystem. So that starts with NetSuite and Oracle Cloud Infrastructure, but extends to database, to Java, and our rich application suite. We also make strategic equity investments alongside our M&A function under our corporate development line of business.
You were the moderator for a session at the St. Louis Business Grows Here event called Raising Capital to Fuel Growth in an AI-Driven Era. Could you give us an overview of the panel for all our listeners?
Sure. We covered a good bit of ground here, starting with the state of the economy and what it means for venture and founders growing their businesses in this era. I had the pleasure to interview Craig Herron, the managing principal of iSelect, a venture fund focused on the agri-food supply chain and healthcare, and Dan Connor, a general partner at Ascend Venture Capital, who leads an early stage thematic VC specializing in data-centric companies. So we talked about the state of the economy and what it means, from rising interest rates, fewer public listings, valuation corrections, to other complex macro headwinds, and how it really translates to startup business building, and then how that has changed fundraising in this climate overall too. We spoke to what makes great businesses venture backable, so what the general partners on stage look for in exceptional entrepreneurs. And then we also talked to tactical advice on just a general approach to fundraising and how to run a successful process. Hint, exactly like you would a sophisticated enterprise sales strategy. And then, of course, we concluded with the surge of AI capabilities and how we're going to be more productive with less, how that's impacted our industry.
Why do you think this session was so important to include in our St. Louis Business Grows Here event? I mean, what is it about today's landscape that made it especially timely?
Yeah, I think it's so important that we highlight the investment in commercial activity that's booming in the Midwest, and specifically in St. Louis and broader Missouri for this Business Grows Here event. Oftentimes, we get this false perception of only venture activity buzzing on the coasts. And while the majority of mega rounds do happen there, at the earlier stages, we're seeing more and more data show the spread of entrepreneurial ecosystems emerging across this entire mid-continent. Steve Case has a great rise of the rest phenomena, right? And so with connectivity everywhere in the world, everybody has access now to build a great company.
What was the highlight of the venture capital panel in St. Louis for you? Any particularly interesting thoughts you heard?
I can recall, I loved a quote that Dan pointed out in the panel, which was really a description for founders to go back to the fundamentals that I see so many startups miss. Your customers are the most important stakeholders, period, full stop. Without them, there is no business. So he described a funny metaphor saying they look for mission critical businesses to invest in. And so if a customer, the example he gave was somebody's hair is on fire and you may be selling sandwiches, which could be the best in the world or best in town. But if someone's hair is on fire, they're probably not going to want a sandwich. A much better business would be, leasing fire extinguishers or something else that drives mission criticality.
What are your thoughts on the venture capital landscape as a result of the panel? What did you leave with?
I'm really bullish on the venture landscape, as I've always been, and believe that entrepreneurs have the chance to shape the world for the better while advancing humanity. In this particular time, especially, when we look at other hard times in the economy, an astounding number of companies were created from the last 2008 recession. WhatsApp, Venmo, Pinterest, Slack, Uber, Airbnb, list goes on. Same thing happened after 2001, and just less than half of Fortune 500 companies can actually trace back to being created in a crisis. And so why is that? People look for security, behaviors shift immensely, fear plays in. And so the world becomes a pretty giant opportunity for entrepreneurs to take advantage of in these times.
That's such a great description. Kind of uplifting. I love it. So to end it, are there any best practices that you have for any listeners here that might be seeking funding right now or in the near future?
There's one insight that's always stuck with me profoundly, which is this investors invest in lines, not dots metaphor. And what that means is rarely investors will wire you funds after your very first meeting, which is a dot or a data point. More often than not, they're evaluating your execution, your communication, trust building over time. And so each meeting that you have with an investor is a dot or a potential data point. And what investors are really looking for is to connect those dots. They're investing in the connection.
That's fantastic. Thank you so much for joining us, JD. I really appreciate it.
Thanks, Megan. Enjoyed it.
NetSuite by Oracle, the #1 cloud financial system, is everything you need to grow all in one place. Financials, inventory, HR, and more. Make better decisions faster so you can do more and spend less. See how at netsuite.com/pod.
With that, let's jump into the panel recording with JD, Dan Connor, General Partner at Ascend Venture Capital, and Craig Herron, Managing Principal at iSelect.
So, today's climate in venture, it's been an interesting couple of years, to say the least. So investors are dealing with, the uncertainty of rising interest rates, fewer public listings and exits, valuation corrections, and a bunch of other complex macro trends. So hopefully Dan and Craig will just distill and this information and maybe give us some insights as to how to raise money in this climate. I still strongly believe that there is a ton of upside to growing a business in today's world. So a brief introduction, maybe we can start with Craig Herron, who is the Managing Principal of iSelect. And then we'll move on to you, Dan, who is the general partner at Ascend Venture Capital. I'd love for y'all just to give us brief introductions of who you are and your fund's focus and maybe your core theses. Craig?
So iSelect Fund, we've deployed about $200 million over the last several years. We've invested in 78 companies. 65 of those are still active. The others have exited. We invest in 3 areas: the agri-food supply chain, health wellness with a focus on cardiometabolic disease, and then food is health. How do we use nutrition to change the healthcare system?
Great.
First, I'd like to say this is a great event. Awesome job to everybody, the production team and all the staff. This is awesome. So I'm Dan Connor. I'm the founder and general partner of Ascend Venture Capital. We're a thematic VC, which means we're focused on a specific theme. Currently, the theme that we're investing under is this data-centric transformation that's happening across every industry. The expectation that every decision should be made based on data. For instance, 15 years ago, when you used to land on a plane, sometimes they would get on the PA and say, this plane was just landed on autopilot, and it used to freak people out. But now, if you got on the plane and the pilot said, I'm just going to do this one by feel. I got this one. It would be equally as terrified. So that just signifies how much that shift has taken place. We're investing out of our 3rd fund right now and just making trouble in the venture capital industry.
Awesome. We love trouble. So before we go on with a couple of questions, I'd love just a quick show of hands just to see who we've got in the room. Who are entrepreneurs or growing small kind of or early stage startups? Can I get a show of hands? Traditional SMBs, if you identify maybe over there. Great. Investors in the crowd? Okay. And then large enterprises, corporates? Okay. How about Cardinals fans? Okay. You guys aren't sleeping yet. Good. Great. So as we all know, many businesses hit an inflection point and need capital to fuel their growth. But raising venture funding isn't always the most strategic decision. And so I'd love to hear from each of you what actually makes a great business venture backable, and then maybe what are some qualities of exceptional entrepreneurs. Dan, if you'd like to kick us off.
Yeah, so initially in our search, we're looking for 3 things. Number one, does it solve a mission critical problem? Is the problem solving a problem that is the product solving a problem that ranks among the top 3 strategic priorities for the customer base? The example, the allegory that I give is if your hair is on fire, I could try and make a case that our sandwiches are the best in town. And you're probably going to need a sandwich at some point in the future, but it's much better to be in the business of leasing fire extinguisher services at that point. So mission criticality. Second, is the business transformative? If it works, does it change the whole face of an industry? We're not looking for a slightly better or slightly more socially conscious Uber. We're looking for something that changes the way that things are done in an entire industry. And thirdly, is it a unique value proposition? Are they solving a problem that is completely different from how things are done today? And are they the only one that's taken that approach? Those 3 things to me make a venture backable business.
So I'd agree with everything Dan just said. I'd throw in 2 more in there. So first of all, size of market, right? If you're going after a $100 million market, there's really just not enough room to scale there. We're looking for markets that are, potentially billions of dollars. So if you get a decent market share, that there's a big opportunity for the company to scale and grow. And then second is team. You got to have a venture backable team at that point in time. So those are, typically we're looking for people that have come out of leading research institutions or, have been entrepreneurs already once, or, if they're in the ag business, they're spent a career at Monsanto in a specific area, or been at Danforth, or, some of the other kind of major centers in that given industry.
Yeah, and there's a really great metaphor that we like to share with a number of entrepreneurs that we work with, which is that as you go out to market and raise funding, investors often, they invest in lines, not dots. And so what this means is that you may meet an investor on day one and you may walk out with a $10 million blank check. That typically doesn't happen 99 point % of the time. But what does happen is typically investors are looking to invest in each of these data points. Every time that you meet an investor and you show growth in your company or you communicate what's going on, you're overcoming challenges, it's the progression of how you go through business is often what we look for in early stage companies. And so if you think of that strategy, then you can line up, as you go to market, I want to get as many of these lines in as possible. And so start these relationships as early as you can and demonstrate growth over time. So to that theme, I'd love to hear from each of you, maybe a little bit about real tactical advice that you have for early stage founders. So often we get caught up with, there's a lot of glitz and glamour of venture capital, and they raise these $100 million rounds. And hey, how did you do it? And $100 million rounds. Yeah. Exclamation point. But what if you're just going for an early, call it seed or Series A stage raise, and you're kind of early to this practice, what best practices can you recommend?
I'll jump in. So there tend to be a lot of incubators and accelerators out there that are specifically focused on a given industry or segment. And, often if you've not been a successful entrepreneur previously, they provide a lot of great education. They have networks to introduce you to early adopter customers, and they can also introduce you to VCs, and typically have VCs or angels that are interested in investing. I guess secondly, it's great if you're coming with a customer in hand, right? Because every VC wants to see some sort of traction, that there's actually been a proof point that this actually is going to work in the marketplace. And I guess I'd leave it at those two to start with.
Absolutely, yeah. So 3 things I would add to that. Seed and Series A have gotten extremely squirrely right now. It's very hard to engage investors. The number of investors who actually have capital to invest has gone down since 2021, when actually a lot of folks raised funds and then were immediately unsuccessful at investing them. The best way to lose a small fortune is to start with a big one. And that's what's happened in venture capital recently. So a lot of people have gotten tighter with their funds to invest in new companies at all versus doubling down on existing portfolio companies. So seed and Series A have gotten very squirrely. So the first piece of advice I would say is you got to triple the number of investors on your list that you're planning to reach out to. Triple it, and then triple the time that it's going to take you to dedicate to fundraising, because it's a slog, and the number of times that you have to follow up with one investor to get a response has gotten a lot longer. So that's what I would say is build a database of 3 times the number of investors that you're going to reach out to, and reach out to every single one by one. It takes hard work, but I know I'm not the only troublemaker out here, so I feel like it's something that everybody's dedicated to. Secondly, as you have those calls, as you engage with those investors, you have to also be listening to what they're telling you about. We invest in seed stage companies, or how they define seed stage companies, or we invest in Series A companies, and you're too early for us. As they say that to you, you say 2 things. One, okay, tell me your criteria so that you can take good notes on that call, and then keep that database. And then thirdly, say, if they're saying you're too early for them, say, would you mind if I put you on my investor newsletter to keep you updated in a lightweight way? You'd be surprised at the number of folks who do that, ask permission to put you on their newsletter for to begin with, or actually follow up with newsletters. It sets you aside. It keeps you front of mind. And then when it comes time to raise that next round, your Series A or Series B, you have a list of folks who've told you their criteria and that they will invest later on if you hit these certain milestones. So that it's not the first call when you're reaching out to folks and saying, we're actively fundraising. We got 2 weeks left to raise this round, or else we're out of business. So those 3 things. So first off, triple the number of investors you're going to reach out to, and the time it takes to actually dedicate to fundraising. Number 2, reach out to every single one and keep good notes on everybody. And 3, maintain a monthly newsletter that you reach out to and drip campaign to everyone in that list you connected with.
To add something to what Dan just said and agree with those, there are a lot of tools out there that are available to you for free. Crunchbase, other things that you can go out and do research on the VCs. It's helpful to do the research up front, figure out who actually could be investing in your space. The other thing that, from a very tactical standpoint, is that different VCs have different ways in which they will source deal flow. So there are VCs out there where if you don't get into a partner, right, there's no way you're going to get funded, right? And so sometimes going in at a lower level through an associate or otherwise isn't going to get you where you need to be. But there are other VCs like us where we make team decisions. And so it's, coming in through any member of our team is perfectly fine. But it's just, you should try to figure out that going in so you make sure you're trying to get a connection into the right person that's actually going to be able to take your deal through and through to an investment committee or otherwise.
I'll give you one more hack, which is a really strong, warm introduction. It's often hard to get if you're not already sort of well-versed and connected within the networks, but often people think, hey, this investor can introduce me to other investors. Like a lot of times, right, that network runs strong and they all know one another. We all know one another. Actually, I think the most quality warm introduction you can get is from a portfolio company. So from a different founder that they've already put money to work into, because there's a reason they've already gotten that check. And I venture to guess that you all are going to probably take that call probably 100% of the time if a company that you've invested in is, telling you to, hey, meet XYZ company. And then, to Dan's point, like, run this like you're running an enterprise sales operation. Like it is a numbers game at the end of the day. And so you do have, it can be a slog, and but with the right planning and persistence, you will break through to get there. And then go ahead.
I was going to say, I'd throw one other thing. When you figure out who your top list of, like, this is the perfect VC, right? They do exactly what we do. And then go pitch to 10 other people first, right? Because you don't want to go into that VC the first time if you've never done a pitch before, right? You want your materials refined. You want your presentation refined. You don't want to be reading your presentation. The kiss of death is somebody who gets up there and just reads slides. But we, unlike some others, do like to actually be walked through a deck. But I don't want somebody who's just going to read it, like they were standing in a room giving a presentation.
You have to get the reps in. And I want to put an emphasis on Dan's point with a question that he kind of skirted by, which is, when you are meeting investor, how many folks have met and raised funding or attempted to raise funding, and you've gotten hey, no, this is a little bit too early for us? Has anyone ran into that? If you haven't, you most definitely will. I promise you. And so the way to answer against that is just asking the question, in a very polite way. Hey, what would you want to see or need to see to make this an investable business? You can curate a lot of that information from investors or other folks that you're meeting, and that sets at least a rough guideline, right, to where you're going.
I'd like to ask a question.
Yeah.
So of the folks who've talked to venture investors, how many of you have a story of an investor that's just acted in a thoughtless, like inappropriate or unprofessional manner, like ghosting, not showing up, any stories like that? Well, if you haven't, you will, because there's a lot of really, really subpar human behavior that's rampant in the venture industry, especially in the early stages. So you need to have a hard shell and make all that, just take it and then move on to the next, and then remember those stories for when you're IPOing and you're having drinks with everybody in your team and telling those stories about those investors later on, because it's a big problem.
Yeah. So on the other side of the equation, maybe do y'all have, like, what major pitfalls should entrepreneurs avoid? Is there some proactive insight you all can share to get ahead of some challenges before the entrepreneurs run up against them?
So first off, not dedicating time, a set period where fundraising is your main focus. If you're running an organizational sales campaign, you're not just running an undefined period. You're setting aside certain hours every day where you're tackling a certain number of investor prospect reach outs that you can handle on a weekly basis going forward, just week by week, and reaching out to as many as you can, engaging as many as you can. It's hard to do. It's hard to carve out that amount of time in your schedule because you're doing 50 other things. I get it. I founded this firm in 2015. We've been scrambling ever since. So setting aside that dedicated time and actually reaching out to literally hundreds of investors, is something that it will set you apart.
I don't know about Dan's, but for our firm's bias is against particularly at the seed and A level of an entrepreneur hiring an investment banker or other representation, right? We view it as the job of the CEO to go out and raise money. And that is, if we want to see that the CEO is putting in that kind of time, that kind of effort, et cetera, in order to do that role at that level. When you get to a C or a D level, yeah, there might be more reason for a banker to get involved, but typically not at a seed and A level. Otherwise, make sure you're prepared, right? You're gonna get a lot of questions. To Dan's point earlier, there are a lot of people out there who can be not the nicest people in the middle of pitches,
but these are not two of them. friendly faces on stage.
Actually, I could honestly say that we've gotten into a lot of deals by not being jerks, as opposed to gotten kicked out of deals for the other reason. But to that point, people do try all sorts of different mediums to raise funds because it is quite challenging right now. There's a lot less dry powder, it's called, out there. So since the venture investment dollars have gone down in both dollars and deal amounts since 2021 and 22 at the highs, we're living in a new world. So just curious what you all have been seeing maybe in Missouri or more broadly with your firms. Is this impacted in investment activity or deal flow for each of you? We're actually still doing a decent amount of seed and A business. We'll do 6 to 10 seed A rounds this year, which is pretty consistent with par in the past. In the past, we also we're doing more B and C and later stage deals. All of that effort is now solely focused on our existing portfolio. And for that matter, a decent amount of the A businesses as well. And so there's, and in terms of like us prospecting or doing outreach for, or even inbound for seed deals, where we've cut back on the amount of time we have available for that, just because I've got issues I've got to deal with my existing portfolio that take precedent over putting new capital to work for new investments. I'm sure Dan's going to echo the same thing, because that is pretty consistent across the board. You're seeing a lot of firms that used to do early stage stuff retrench and do later stage, change the criteria. They're now growth investors looking for 10 plus million in revenue. So yeah, it's definitely gotten a lot more challenging.
Yeah. So actually, we're a kid in a candy store right now. During the pandemic, there were 60% more companies started every month than any time before in history. So for every 3 companies started prior to the pandemic, there were 5 started every month, just based on how the averages were working out, and that was sustained for 3 years. So there are so many new companies right now that have been around for a couple of years and are now looking for seed Series A funding. It's immense. The number of companies that we used to be able to review every month just to keep up was about 300. Now we're scrambling to do 500 a month, and we're not keeping up with the number of companies that are entering our search criteria. We need to be doing more because there are just so many companies, and that's the most exciting time to be investing, because in these times of turmoil in which people lose their jobs, they leave their company because they want to go live on the beach and are sick of it. They bring the knowledge and the funding that they have to start a new idea, and the most consequential companies get started in these times. Google was founded in the .com bust. Airbnb was founded in the global financial crisis. These iconic companies get started in times just like this, and we're scrambling to find those gems in that deal flow. So in Missouri, I guess I'll put it to you this way. So what can anyone tell me what geography has the monopoly on brilliance, on brilliant founders? Can anyone tell me what the limitation of sending an email is geographically? And there's none. Can anyone tell me how much more difficult it is to send money from one place in the country to another outside of Missouri? There's not. There's no limit on where you have to be to be able to start an iconic company. The talent pool is everywhere. Brilliant entrepreneurs start up everywhere in the country. Sam Altman's from St. Louis. Taylor Swift's mom lives in St. Louis. Because not answer. So there's no limit to where you can go with your company. You can sell into the e-commerce market from anywhere. I think that's one thing that's changed as well, that folks have gotten a little more devious in terms of the revenue, in terms of the dollars they're bringing in. Every dollar of revenue is by the math an infinite valuation fundraising dollar. And so getting devious about new product lines, new revenue lines to actually front your growth in the future is something that's, and then SBA loans, bank loans, grants from Greater STL. I mean, there are funding outside of venture capital if that has been to drive a well. So
that's right. It's a really good point. We'll be sure to have an angel panel with Mrs. Swift and Samuel next time around here. One more question to you both, which is just given the surge of AI capabilities, it's clear that we're all going to be much more productive with less. And so founders and investors alike are, it seems to be a trend. We're all moving back to the fundamentals of, not grow at all costs, but maybe grow with efficiency, or dare I say profitability, maybe. So I'm curious, how does this affect your thesis, or, have your expectations changed when you're meeting early stage companies?
So we're thesis driven, as I mentioned. So the theme that we've been focused on since Fund 1 is this data centric paradigm shift that's been taking place. Every company needs to become a data company to stay competitive. I think that you can make the case in the future that every company is going to have to become an AI company to stay competitive. But right now we're in the middle of the hype cycle, so I'm not ready to stake a fund in investing in that theme. But I think that in the future it may be. On the ground, I think that we're seeing a lot more, as you mentioned, efficiency, productivity coming from individuals in an organization, and that has been a trend that's been happening for the last 60 years. Super producers are emerging, and finding those other super producers to join your team is the way to grow a company fast. It costs less to start a business. There are fewer people required to start a transformational business. OpenAI was 4 people when they were valued at $5 billion. The time is coming where there will be a single person company who is worth $1 billion just by the path of that trend. So maybe it's you.
Just even in our sectors, we are investing a lot in AI-driven companies. I'd say the first thing is if you're really really need to make sure you're an AI-driven company and not, just adding it to your name for the sake that it's the hype, as Dan said, the hype cycle, because it's pretty quick to tell whether or not you're really an AI company or not, right? And the kiss of death is labeling yourself as one when you're really not. It really hasn't changed our theses or the kind of way we look at things. To the other side of that, in terms of shifting back toward fundamentals, I'd say certainly in our later stage portfolio, we are much more driven by how quickly can we get to cash flow. Yeah. Early stage portfolio, there's still a little bit of leeway there, but you better you better have clear line of sight to customers, revenue, everything else. If not, preferably already have customers, revenue, minimal viable product, etc.
In general, bootstrapping or not raising venture funding leads to limited resources, which often leads to better decision making, which then leads to better outcomes, right? And so we see it all the time. Too many people get the $100 million round. You have more cash than you know what to do with. And so actually there is some truth to growing a real sustainable business in this way too. So we're about out of time, but I wanted to give each of you just an opportunity maybe to, for a piece of parting advice you'd like to share with entrepreneurs in the crowd that are going out to raise or maybe in the thick of it right now. So Craig,
I'd go again with early adopter customers, right? The more, every business needs a customer. So if the faster you can get them, the quicker you can get them, it shows somebody you're trying to fundraise with that you've got traction, that the product is actually something somebody wants to buy. And it goes just a long, long way towards proving out that whatever it is your invention or idea is actually going to work. So focus first on customers, and then think, how do you go from there?
My advice would be bold, go boldly. The thing that binds us is this human element that everybody that we're interacting with should be expected to be interacting in a positive way. And if you can just get in front of that person with the right, think about where they are in their day, what they do on a day-to-day basis, and get in their shoes, whether it's a customer or an investor or a person who you're courting to join your team. Make sure that you understand that person's culture, their driving theses, and figure out how that you can craft your story to get in front of that person. I talked about how the entrance road to the global economy is wide open. And it's unlimited, but the thing that we remain rooted in is our culture, our the way that we do things as tribes, the knowledge that we share as individuals in a group. That is extremely important, and remembering that as you go out and try and meet new customers and build relationships is crucial. And the only way to do that is to remember that human element. So be bold.
It's great. I'll have the last word on this. So Doug Leone from Sequoia has a great quote where he says, "Architect your cap table like you would your product." I mean, really just stressing the importance of choosing, your early investors and partners. They're going to be going on a very long journey with you, right? If this works out and is successful. And if it's not successful, you also want to make sure that you chose the right partners alongside that. The one caveat with that is the best deal is the check that gets signed. So at the end of the day, that's what you want to, you've got to do what you got to do to grow your business. And anyway, so with that, guys, thank you so much for being here. I know we're just out of time.
Thank you.
Insights.
Thank you. Thank you, local.
Well, that wraps up another great episode. One of the pieces of advice that I found most interesting from the panel was being realistic around how much effort it would take to raise money in today's environment, and founders needing to triple the amount of investors they reach out to and triple the amount of time spent fundraising. It might be harder to get an investor on board right now, but like JD said, some of the biggest companies have been built in times where investors weren't as willing to invest. Thank you so much to JD Weinstein for not only moderating the panel, but also taking the time to join us on the podcast. A big thanks as well to our panelists, Dan and Craig. If you want to learn more about NetSuite's Business Grows Here events, be sure to check out the link in our show notes and see if we're coming to a city near you. As always, a big thanks to our wonderful editing team over at Oracle, and to all of you for tuning in. If you want more episodes just like this one, make sure you subscribe to our channel and give us a rating and review. Until next time.
You just listened to the NetSuite Podcast. Be sure to tune in every week with more NetSuite developments, stories, and insights into the benefits of one integrated system to help you run your business.